What if the biggest risk in the stock market today is not a crash, but a market where everyone is forced to own the exact same stocks? Because that is quietly becoming the new reality of Wall Street. Not just for retail investors, not just for hedge funds, but for the professional money managers who are supposed to protect against this exact situation. And the reason is artificial intelligence. This week, Bloomberg revealed something important. Before the Iran conflict escalated, nearly half of active large-cap mutual funds were beating the S&P 500. Now, only about 25% are still ahead. Why? Because investors rushed back into the same AI and mega-cap technology stocks carrying the entire market. And if you were underweight those names, you got punished immediately, which means the market is starting to reward imitation more than independent thinking. That sounds normal on the surface, but underneath it is a much bigger structural change. AI is not just creating winning companies, it is changing how capital behaves. And that may be breaking one of the core assumptions modern investing was built on. For decades, diversification was considered safety. Own different sectors. Spread your exposure. Reduce concentration risk. That was the institutional playbook. But the AI era is creating a market where concentration is outperforming diversification at an extreme level. And that creates a dangerous feedback loop. Here is the first layer. Indexes like the S&P 500 are cap-weighted. That means the bigger a company becomes, the more influence it has on the index itself. So when Nvidia rises, its weight increases. As its weight increases, passive index funds automatically buy more of it. That pushes the stock even higher, which increases its index weight again. Now add AI hype on top. Suddenly, investors believe only a handful of companies possess the chips, infrastructure, data centers, and scale needed to dominate the future economy. Money starts concentrating into the same firms: Nvidia, Microsoft, Meta, Broadcom, Amazon. And eventually, the benchmark itself starts behaving like a leveraged bet on AI infrastructure. At one point this year, the top 10 companies in the S&P 500 accounted for more than 1/3 of the entire index. That changes the incentives for every active manager on Earth. Because active managers are not judged in isolation, they are judged against benchmarks. And if the benchmark becomes dominated by a few AI giants, then underweighting those names becomes career suicide. Even if valuations look stretched, even if risks are building underneath. This is the hidden shift most people are missing. The market is slowly forcing active managers to become closet index funds. Not because they want to, because survival demands it. A manager who avoids crowded AI trades may look smart for 6 months. But if Nvidia jumps another 30%, clients leave before the thesis ever plays out. So the pressure becomes overwhelming. Own the winners. Chase the benchmark. Do not fall behind. And that is where things become unstable. Because now diversification itself starts disappearing from the system. Everyone crowds into the same names, the same trade, the same narrative, the same AI future. And once enough capital behaves this way, the market becomes fragile, not because nobody sees the risk, but because nobody can afford to avoid it. This is where the Bloomberg piece gets especially important. The article points out something strange happening beneath the surface. The S&P 500 recently hit fresh highs, but fewer than half of stocks were above their own 50-day moving averages. That is abnormal. Historically, when indexes make new highs, participation is broad. Industrials rise, banks rise, healthcare rises, consumer stocks rise. But today, a handful of AI-linked companies are carrying most of the market. That is classic narrowing breadth. And narrowing breadth matters because it creates hidden dependency. The entire market starts relying on a shrinking number of companies to hold everything together. That means a problem inside a few names can suddenly become a problem for the entire index. Now, layer in the bond market. This is where the story gets deeper than just technology stocks. The AI build-out is becoming so massive that it may be changing inflation dynamics themselves. Data centers require enormous electricity. AI infrastructure requires huge capital spending. Semiconductors require industrial expansion and global supply chains. That spending wave may be one reason inflation expectations remain sticky even while parts of the economy soften. And according to Goldman Sachs, the relationship between stocks and treasury bonds has shifted sharply negative again. That matters because bonds traditionally acted as protection. Stocks fall, bonds rally, balanced portfolios stabilize. But now both sides can get hit together. especially if AI spending keeps interest rates elevated. So think about the setup Wall Street is entering. Concentrated equity exposure, crowded positioning, weak diversification, higher bond volatility, and benchmarks increasingly dependent on a handful of AI firms continuing to execute perfectly. That is not a normal market structure. That is a market becoming dependent on a single narrative. In other words, systemic diversification is no longer a shield. It is becoming an illusion. Now, to be clear, this does not automatically mean the AI trade collapses tomorrow. That is important, because many bubbles stay rational longer than people expect. And AI is producing real revenue growth, real infrastructure demand, real earnings momentum. The problem is not whether AI is real. The problem is what happens when the entire market begins organizing itself around one assumption. Because history shows something important. The most dangerous bubbles are not built on completely fake ideas. Railroads were real. The internet was real. Housing demand was real. But when capital crowds too aggressively into one future outcome, the market eventually loses flexibility. And flexibility is what keeps systems stable. That is why this matters for regular investors too. Most people think they are diversified because they own index funds. But increasingly, many index funds are becoming heavily concentrated AI bets without investors fully realizing it. If a few companies dominate index performance, then your retirement portfolio may be far more dependent on Nvidia earnings than you think. Markets become dangerous when everyone believes they are diversified, while secretly owning the same trade. And that may be the real AI bubble Wall Street still refuses to talk about. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.